Everybody, welcome back to Reds Roundup. In this video, we're going to be looking at something that I've been thinking a lot about recently, and that's what it would mean for there to be normalcy in stock markets, and in particular in the United States market. So I'm sure you've seen videos from 1,000 people, even CNBC, saying stock market crash. When is it going to crash? All this stuff about crash, crash, crash. That's not this video. This video is just taking a long-term view on stock market and where it's at right now and what it would mean to have some normalcy. So first chart, a pretty simplistic one. I'm sure you've seen it. It's total market cap over GNP. You may have seen GDP. It's at all-time highs. This is one indicator of many that is showing that there's big overvaluation in the stock market. The next one I think is actually pretty interesting, and not as many people have seen it. This is the predicted forward 8-year return of stocks given the total market cap to GDP and where the market is right now. So we see, quick overview. The green line is the actual return. So this is what actually happened, that green line. The blue line, this blue line right here, that is what is predicted with a 120% market cap to GDP. And this yellow line is what's predicted given an 80% market cap to GDP. So it's been fairly accurate predictor of stock returns over the next 8 years. This factor, and as you go out further, I think it becomes even more accurate. So the greater the amount of time, the more accurate it becomes. So we see that for the most part, the actual return has always been under these indicators at around 10-11%. And this was with some moderate inflation too, I might add. So then we see here this period where it was much higher than those two numbers, and that's because that was around 8 years before the dot-com boom. And then it crashes way off, and that's because the dot-com boom. Sorry, I'm trying to avoid the annoying mouse. And then we see here the only other time in this chart since 1970 that's been negative was around the dot-com bubble. And that's what we see now, where the expected return is slightly positive, almost zero, or negative, depending on which one ends up being more accurate. And you can see it's a fairly accurate predictor of what's going to happen in the stock market. So, and I might just add, sorry about this freaking thing, it's so annoying. You would have done very well in stocks and investing over this period of time if you would have just held stocks when it's predicting that it's a high return, and then when it's a low return, just selling your stocks. You would have ended up doing fairly well, and then just buying back. You would have ended up doing well, and we see that now. And I feel like with hindsight, with the dot-com bubble, everybody should have sold their stocks then because everything's so expensive. I think that's kind of what's happening now. I think there's very little opportunity if you're an index investor or not a particularly uncorrelated investor. So you've got to make a lot of correlated bets to the market. This isn't a great time to have a lot of money in, much less have a lot of leverage, because the predicted returns are zero, if not negative. Okay, so we get that. So I decided I'd just do some looking at the S&P charts. Oh, that's interesting over time, like big drops. This is a logarithmic chart. And I noticed something. There are very few times where the stock market just goes up and to the right like that, like it has for the past 10 years, 12 years. The closest periods we can see are after the Great Depression for a little bit, but even then, it was not 10 years of that long of outperformance. And then we see here lots of choppy behavior in stocks, and then Yeah, so that's what I've been looking at, and I decided to do a little bit of a thought experiment. I was just gonna go back and do a little bit of charting. This isn't any technical analysis, but this is just more of a thought experiment. And my thought experiment was, what if what if we are in the dot com bubble? Let's just say we're at the peak of the dot com bubble. I'm not saying we are, but I'm just saying mentally, I think we should be prepared for this fact of investing and dealing in the stock market. And that is that stocks could be flat for the next 13 years. And that's what happened from the peak of the dot com bubble. And this is the S&P 500, mind you, not the Nasdaq. If you would have looked at the Nasdaq, it would have been much longer. It might be like 2015, 2017, something like that. Very long time to earn your money back. And this, I will say, given, is not including dividends reinvested. So we're just taking dividends out. But 13 years to make your money back in stocks after the dot com bubble and great financial crisis. So, what if that would happen today? Would you be prepared today if stocks were flat for the next 13 years? Now, that's a hard question to ask yourself. 13 years is a long time in pretty much anybody's life. But 13 years of flat stock market, would you be able to outperform in that type of environment? Now, I don't know for myself whether that would be the case or not. Would you be even able to hold on to your stocks for that period of time? I don't know. Would you be willing to invest more? That's a question for you to answer. I think I would be. And I think a lot of people right now consider themselves long-term investors, but I don't think they would be able to handle it if stocks didn't go up for the next 13 years. Not to mention if we had a crash. And I know everybody's worried about the crash and it looks scary. Oh no, like what if we lost 50% like we did in the great financial crisis in about the same amount of time? Like, that's scary. Going down to the around the 2014 to 2017 levels of the stock market. That's scary. But that's not really what you need to be worried about because if it just goes down, like, okay, that's fine. But if it just goes flat for the next 13 years, pretty much, that's even more scary because we could have what happened in March where it just went down and went straight back up to all-time highs, like it never missed a beat. So this is really what I've been thinking about is what would I do behaviorally if stocks are flat for the next 13 years? And that brings me to one other chart, and that is what happened after the Great Depression in the stock market. So this was pretty much the bubble of all bubbles. We've all heard about it, probably learned about it in school too, how there was excessive margin use, all sorts of other tedious temptations in the financial markets, and then bam, stocks lost almost all their value or price. The price went down a ton. And then stocks were flat for 25 years. So you might think you're slick in the run up to this happening, but pretty quickly you realize like the stock market's not a joke. You really have to be in it for the long run. And if you're not, you probably shouldn't own stocks. And that's a hard thing for a lot of people to grapple with. That if you're not willing to hold a stock for 25 years, maybe even, or be invested for 25 years, you probably don't deserve stock returns, which is a hard thing. Because if we go back to here, we live in a time where stocks just go up. That's even the saying. Stocks go up. Stocks only go up. The meme stocks, all that. So, I don't know. I would encourage you to be very cautious when it comes to how you're approaching investing right now. And that brings me to something else, which I'll probably make videos on later, is that I've actually been starting to take money out. I've been taking a little bit of money out, putting it into things that I think are more conservative. Because a lot of my best ideas have gone up a lot. I'm very grateful and happy with that. And right now they're just too expensive. They're too expensive for me to own, and I really can't find anything that is screaming at me, oh, this is a deal, deal, deal. I think there are some things for conservative investors to do. But that being said, I like cash right now. Despite everybody thinking that inflation is going to go wild, I don't. actually think inflation is going to go wild right away. I think it will take a while. And I think we would have to see an asset price bubble pop before we see inflation, because I believe that any inflation that we are seeing is showing up in asset prices, and it would need to go out of asset prices, which would pop the bubble, in my opinion. So that's what I'm seeing, and I'm really looking at this like, okay, the expected return is going to be negative, and I'm not loving that. So I better have a pretty good reason to invest money right now, given that whenever it's negative, if you just wait a couple years, it usually turns quite positive, which is interesting. So I just wanted to make that video. I know I've promised to make a lot of other videos about various subjects, but I've really just been contemplative recently, given that things are so hot. And I really don't see a need for me to be making any hot calls on any new stocks, given that this isn't market timing or anything, but given that if I just invest in pretty safe cash flow streams or even cash, I'll be able to deploy that money later at higher rates of return. So thanks for watching. Tell me what you think. Tell me if I'm wrong. And don't tell me if I'm right. Thanks.